All right, hello everyone. We are going through the weekly Q&A. This is September 6th of 2023. Today I got a few questions coming in from about just like trade setups and how to set them up and what, just little questions about those types of things. So we're going to crush through that. We'll have a little bit of discussion about the reverse repo market and some questions that kind of come in, like how does that actually happen? How does that show up? And then we'll also discuss things like blending multiple strategies together and kind of how that works. Like I said, well, I've said this before, at least if you're part of the forums or anything like that, that we are eventually going to have a class that goes very much in depth about how to blend the strategies. But we'll even just talk about why you'd want to do that today, just as a quick little overview. Then, of course, if you are here live, you can throw us a question and ask me pretty much anything, and I'll answer it pretty much on the spot as soon as I see it come over. Okie doke. So without further ado, let's talk about the reverse repo market first. So reverse repo market is this piggy bank that we've been talking about for a couple weeks now that has been draining. As this drains, it pushes stocks and bonds higher. You can see that we've had a significant push. Well, it doesn't push bonds higher. It stabilizes bonds but pushes stocks higher. So anyways, as that's pulled down, you can see that that actually lifted up stocks. Now we've had a couple little down days with a little bit of rise in the reverse repo market. So we'll see if this continues to drain or if we stabilize. If we do stabilize, we will likely see this continue to the downside. If we do continue to drain, then we will likely see a little pop up here and then maybe get up to highs again. So we'll see how that ends up transpiring in the future. But the question that I get about this is, why does the reverse repo market have a effect on stocks? And so to understand this, you kind of have to understand the Fed balance sheet. So we have the Fed balance sheet back here, and as the Fed balance sheet grew back post-COVID area, they were printing money, but inevitably the economy / banks didn't need more money. At this point, any new money being printed was just basically extra. And so what banks started to do is they started to pump it into the reverse repo market because the reverse repo market was offering a slightly better yield than the treasury market. And then so what that did is the Federal Reserve kept the reverse repo facilities slightly more attractive than the bond market or the treasury market. And so that incentivized banks to park extra money over here at the reverse repo market if they didn't need the collateral, right? So as this grows and grows and grows, as they kept printing money and printing money and printing money, eventually they stopped printing money right around here. And you can see the reverse repo market very shortly after just basically stops. It stops growing. Then as the economy contracted, right? As the economy contracted, it wasn't really what happened was the interest rate started climbing and the Fed kind of popped the bubble that was created after COVID. And as they popped the bubble, right back here, you can see the repo market eventually kind of stabilized and the bond market was what it was. Fast forward to now, you can see, and even here you can see when the reverse repo market started to drain down pretty aggressively, it was very bullish for stocks, right? But eventually, as the reverse repo market climbed again, it was very bearish for stocks. And then all of a sudden, now boom, the reverse repo market rolls over and is starting to be drained, and this cash comes into stocks. This is very bullish. We stabilize, or the reverse repo market starts to go up, stocks come down. Reverse repo market starts to drop and drain out and go back into the treasury market, stocks go up, right? So right now the Fed is, yes, tightening or dropping off of their balance sheet, but basically what they're removing off of their balance sheet is basically being replaced from the reverse repo market. So As they continue to sell assets, the reverse repo market is basically taking the place of their selling without it actually showing up on their balance sheet, because they grew this balance sheet excessively back here. And now what this does is, if we kind of would imagine these two things together back here, right, are basically creating a situation in which the Fed balance sheet, if we were kind of try to draw the Fed balance sheet is either going sideways or slightly actually going up, but not actually in the Fed balance sheet. It's just kind of the effect. It's the effect is if the Fed balance sheet was either climbing or stopped. And that's a very bullish thing for risk assets, because that means that there's actually money that's not being pulled out of the financial system. It's actually being maybe even put in or growing. And as you put money into the financial system, it creates asset inflation. So, of course, keep in mind that if we print money and hand everyone checks, consumers will go buy consumer things. So therefore, consumer price goes up, right? So CPI rises. If we go out and hand banks money, what do? They buy assets. Great. What happens when you buy more assets? Asset prices go up. So see, you've got these two different things. You've got whether you're supplying inflation into assets or whether you're supplying inflation into CPI. So they've found a way to engineer to where you can get kind of both, right? So you can actually inflate asset prices back here without affecting CPI too much, and then vice versa. So hopefully that kind of irons out that question there. And of course, if you guys have any questions and you're here live, you guys can always ask something as I'm speaking about it. So let's talk about the trade setups, and that is something that is a little bit more indicative of our trades. So there is a reef trade, which here we'll share this tab. So this is one of our reef trades. Now, of course, it's not on all the time, otherwise that would be kind of insane, but this is a reef trade, and there are very specific rules to the reef trade. But if we cruise down here, there is a position exit of, out the back of the butterfly. So talking about that is like, if you get this initial setup on this trade, as it comes backwards, if the market comes out and shoots out the back of this intrinsic value, so basically the angled line, not necessarily over the short, but over, back across the intrinsic value of this rear vertical, that is a position exit for that. So that's what that means as far as those. Another question that we get a lot about is the rope trade. So the rope trade uses a nested butterfly. So I'm going to go in, and here we'll go to this. I'll go into... So here's the rope trade. So the rope trade is one of those trades that has a nested butterfly, but of course its nested butterfly can actually be on both the higher and the lower side. It just depends on kind of what's going on in the options market. So what a nested butterfly is, just to kind of clarify this, is that this long, this lower long is halfway between the upper long and the short of the lower butterfly, right? So your call butterfly is kind of nested inside of here on this ATM butterfly. So that's what it means by nested. And then if we look down here, this is probably the other question that I get the most, is how to make it smaller, how to make trades smaller in general. And you do this by dropping this upper butterfly's width. So you can see that the primary butterfly's width down here is pretty significantly higher. Looks like roughly 100-point wings back here. And you can see that what we did is we shrink the upper butterfly. So we got one butterfly here, and then we have a shrunken butterfly. And that acts like a nested butterfly, but the short doesn't move, right? So the shorts of the butterfly stay where they're supposed to be. So you start out with a full-size butterfly, and then you just shrink it down to get to your rules that you're trying to get to, that theta delta that we're trying to work out to. And of course, you can always see the theta delta down here at the bottom in this TD section. All right, well, we crushed out pretty much the questions that got sent in. They were pretty self-explanatory, or not self-explanatory, but they were pretty simple to explain. And hopefully that answers out those questions. The other question that I got was, why does the yield curve take so long? So let's talk about the yield curve. Why does it take so long for a recession to happen? So let's talk about that. So the yield curve, and we're just going to pull this up here. The yield curve, view on full screen. So the yield curve down here is the front month of the bond market versus the long dated, the 10-year, 20-year. This in this case, this is the 3-month and the 10-year spread. So what happens is to understand why the yield curve typically precedes a recession, we have to first understand why the yield curve inverts and what does it mean. So when a yield curve, or when the front end of the bond market or the front end of the yield curve goes up, it means that the market and the general market participants are expecting inflation to be higher in the shorter term. And then when the back end of the yield curve rises, it means that participants are expecting that inflation to stick around for significantly longer. So the fact that our longer term bonds are sitting at like 4% or so means that the bond market anticipates that our inflation is going to be higher, right? Say somewhere around 3% or so, with the added premium of real interest rates, right? So then you get an extra premium on top of that. So that's what happens with bonds. And so anytime that you get this inversion, it means that there's some sort of inflation spike going on right now that is a short-term issue. And when that happens, typically a central bank will create tightening measurements or tightening measures and start restricting capital from growing to stop the inflation to go too high, right? So the short-term inflation doesn't become a much longer-term issue. And then what happens is eventually that contraction of credit turns into a business cycle contraction, because businesses depend on new credit or cheap credit to grow. And if credit becomes more expensive, it means that they can't grow and take extra risks to grow their business, or in order to grow their business, they have to almost guarantee that there's going to be significantly positive growth over what interest rates are, what interest rates actually are. And that's because if the Fed is offering, let's say the Fed is offering 3% yield, and as a company, you're sitting there trying to find capital to grow a new division of your company, and you've got to fork out, say, 4%, because you do have to be above what the government is giving you, because you're a company versus the government is significantly safer, supposedly. Then what ends up happening is you have to offer 4%. Well, that means that your business venture, your business growth venture, has to guarantee you returns of X amount of above 4% in order to make it worthwhile. And if there is the possibility of it not producing more than that, then that makes it a more risky endeavor. Then you also have it to where some businesses take out extra money to just operate. Those are what's called basically profitless companies. They basically need cheap debt in order to continuously make money by reselling that debt and or buying assets and reselling those assets and things like that, right? So or they're just growth companies. So it's like basically, hey, we're going to take out debt at 2% or 5% or 2% or 1.5% in the hopes that our company is going to grow 200% in 5 years, right? Then that starts to make sense to invest in those companies because inevitably in the long run it will outproduce, and the risk is relatively low because you got cheap interest rates. So anyways, that was a lot that I'm talking about right here, but I needed to explain how capital markets kind of work. Now, as the capital becomes more expensive, like what happens in these inverted yield curve spots, those companies start to contract. They start to kill off all these expansionary projects, things like that. They start to fire people. And then eventually that makes it to where the consumer can't buy as much. And then eventually the front end of the yield curve starts to collapse because the inflation starts to slow and they start to eventually deflate, or you start to get into back into normal territory. And then that is actually what creates the recession itself. So that's why these recessions show up. Of course, in inflationary recessions, versus deflationary recessions, in inflationary recessions, like what happened in the 70s and 80s, is that you have inflation creating the Fed to raise interest rates and purposely invert the yield curve because of a high spike in inflation rather than like an overheating of the economy. What happens then is that you have what's called runaway inflation, and runaway inflation is significantly harder to stop. So you typically have to tighten credit markets significantly more than what happens in a typical growth inversion, right? So growth inversion versus inflation reversion or inversion. These inflation inversions, you have to spike significantly higher. So that's why you see higher inversions, just like what we have right now, than what you do have in deflationary ones like COVID or 08 or the dot-com bubble or even the 90s, the late 90s one, or the early 90s, I think. So anyways, so that's typically what happens as you kind of go through these cycles. And so what happens is why they take so long for them to actually show up, right? You can see sometimes they're a year in advance. 1989, we didn't actually technically get the recession until 1990, and it was even a small one at that. And then we inverted back in August of 2000. Of course, stocks started rolling over almost immediately. And then in 2006, we started to invert in late 2006, but we actually didn't roll over in stocks until late 2007. Same thing in COVID, right? We didn't actually roll over until we uninverted in early or like late, like I think in December or so. I think it was February actually when COVID kicked in. So anyway, so right now what you'd be looking at as far as if we're in a recession or if we're coming into a recession, typically in inflation recessions, it's when it starts to uninvert. So AKA basically what's also going on right now. So you get a spike, which we do have. Let me see if I can get zeroed in on this guy. It's like a little itty bitty guy. Anyway, so you get this spike, and then once it starts coming down, that's actually the point in which you're kind of, oh no, this is going to be a problem. And that's because the Fed will, typically the back end of the yield curve is starting to crank up. And that's because of sticky inflation and things like that. And so what will end up happening is the Fed will crank up interest rates a little bit more, and then eventually it creates a further collapse, and then the recession actually fully kicks in. So that's why the recession is a little bit lagged of the inverted yield curves. All right. Well, that knocked it out for this session of the weekly Q&A. Of course, join me next week. I do try to keep these around the same time. I had a monthly meeting this week because of the holiday, so it kind of made everything a little bit stir. But I do try to keep these at 2 o'clock on Wednesdays, and I will see you guys then.